And welcome back to part 2 of asset protection and learning how to use certain devices. Now in part 1 we covered different things like domestic asset protection trusts, how to use homesteads, depending upon the state you live in. We talked about if a retirement plan was protected or not protected based upon the state that you live in. We talked about insurance. Now let's talk about the foundation of asset protection planning, which is an LLC. Now many people, they don't understand how an LLC works. They know the word, but they don't really understand mechanically how it works. So let's get into the basis or the foundation of it. What a limited liability company is, and this might be the easiest way to understand it. Let's say that you have a golf club or a country club, and you want to become a member of that country club. Well, there is a board of directors, and that board of directors determines who's going to get admitted to that country club or not. And if you're admitted to the country club, there's a manager set up in that country club. That manager of members is the people that are usually the board of directors that either admit or expel certain members. Now, if you're a member of a country club, I'll give you an example, and let's say you're driving down the street and your sun's in your eyes and you look at that light and you think it's green, but it's red. You run the light, you kill somebody by accident. Purely horrible, tragic thing. But the question is, because you're a member of that golf club, if you, let's say, deposited money in that golf club to become a part or member of that golf club, could somebody suing you become a member of the golf club? The answer is no. Even though you have a financial interest in it, they can't get to your financial interest, and they cannot just take your membership. Why? Well, the golf club or the country club has to admit the member, and this is done by a board of directors. This is how you create that firewall between members and the assets that are inside of the LLC. So again, it creates a legal wall between your assets and what you put in the LLC and what happens on the outside. Now, this is where some of the confusion comes in. We're going to talk about inside of tax and outside of tax so you can understand that not everything is completely protected if it's inside of the LLC. So people ask, what is an LLC? Well, these things have been around, don't quote me, 1700s, 1800s in England. And when they came to the US, and I started seeing these show up on the radar somewhere around the mid to late 80s. Now, taking the conservative approach, I decided that these are too new. There was not a lot of IRS precedents. So I sat back, I didn't do anything in LLCs for at least a decade. And during that decade, I'm glad I didn't, because people that were setting these LLCs up, they got into a lot of IRS disputes, because at that time, there was literally no code. There was no precedents. There was no manuals from the IRS. It all had to work itself out with how people were using them. And then the IRS laid down rules, and then each state started to adopt the ability to create LLCs. They are nowhere near as old as corporations, which go back to the beginning of Roman times, but they are newer in their existence. But the good news is now at least the IRS has outlined rules as to how you can use them. So they have a lot of tax flexibility, just like a partnership might, but it also has the protection of a corporation. Now, LLCs can either have one or more than one member, just like the country club. And it depends on what state you live in, what you're trying to do, to determine should you use a one-person LLC. And one person simply means you're the person that signs up. No one else is in that LLC. It's a one-member country club, okay? And you choose how it is taxed. Now, one of the things that a lot of people get confused about is they'll say, I don't understand disregarded. All that means is, let's say that you go and you start a small business, and you file a DBA, doing business as, and you call it, I don't know, Frisbee Central. I'm making this stuff up. So call it some kind of Frisbee company. And you now can operate under the Frisbee name company and sell Frisbees if that's what you're going to sell. And that income and expense comes back through onto your personal tax return. So remember, you file a 1040 personally. Everybody files a personal return on a Form 1040. If you have a sole proprietorship, you additionally file a Schedule C. Why do they call it C? I don't know. It's called a Schedule C, sole proprietor. That's where you book your income and expenses, And any of the profit that that Schedule C throws off, it gets added on top of all of your other income. So salary, pension, partial Social Security, interest, dividends, capital gains. So you have to keep in mind that traditionally in tax planning world, we don't like Schedule Cs. We don't like sole proprietors, not only because it taxes on the income to your other existing income, but there's a big disadvantage with it in that you pay FICA taxes, FICA, that's Social Security and Medicare, and it's about 13.3% or 15.3% if you're the employer paying half of the employees and half of yours. If you bring it all on a Schedule C, you're paying a little bit less, but not that much because you're getting a little bit of a credit. So again, it's very disadvantageous. I'll give you an example. Let's say you are a physician and you're going to run your practice under a sole proprietor. First, you have no asset protection. Everything is going to flow back to you from a tax perspective. If you make, let's say, $200,000, you're also going to pay somewhere around $20,000 to $25,000 in FICA taxes. That can be mitigated by the use of proper LLC planning. So again, you get to choose how it's taxed, whether it's disregarded, whether it's a partnership, whether it's S Corp or C Corp, okay? And I want to bring this up because a lot of people, just because they think they have an LLC, they go online, they do some kind of free sign up and they get the LLC, and then they'll come to us and they'll say, hey, we want to do some tax planning. And we look at the LLC. We'll say, well, you don't have a very good operating agreement, because the operating agreement not only outlines who and what can be a part of the membership, meaning the country club, but it also discusses how do distributions get made? Can we stop distributions in case we're under attack? But also the tax structuring. So you have to make sure that that operating agreement is robust. And what we find is these little 2 to 4 page operating agreements that you get for free when you sign up online, it's not worth it. So look, if you're going to spend $500 to $700 to set up an LLC, and you get this really weak operating agreement and no one is instructing you on single member, multi-member because of your tax structure, no one is consulting with you on whether it should be taxed as disregarded, partnership, S Corp, C Corp, this is where you got to go get the good advice, right? And that's going to run you $1,500 to $2,500 to structure things correctly. So before we get into the tax structuring, let's talk about the actual asset protection and how it works. And we're going to cover something called inside a tax and then outside a tax. So what is an inside a tax? So Billy Bob goes and opens up an LLC. And he's heard this on the news, he's heard this on the internet, he's seen it in all kinds of posts, so he knows he needs an LLC to buy rental properties. So he goes online and forms an LLC for $500, and now he starts buying rental properties. And he puts the rental properties inside of that one LLC. So now imagine Billy Bob's got 5 rental properties inside one singular LLC. Now let's say that one of those properties has an issue. An issue can be black mold, it could be a slip and fall, it could be a tenant dispute, it could be anything under ADA, which is the American Disability Act, and that's a big one. That's a big target for landlords. When somebody moves in and you rent to them, you can't deny them being rented to under ADA, but then when you rent to them, you must remodel the apartment in order to comply with ADA. That may be expensive. It may be changing doorway sizes. It may be changing whatever it is. And if you don't, there's a liability. And you have a certain period of time to actually do that. It could also be, one of my ones I see a lot of, is there's a fire. Somebody gets hurt. Or they may say that they get hurt, and then they claim you didn't change the batteries in the smoke detector. Now, let's go back to this Billy Bob. He's got this LLC. He's got 5 properties in the LLC. Let's say that one of those properties, just one, has a fire, and they blame you as the landlord, and they sue you. Now, because you used one singular LLC, you put all assets inside that one LLC. If that person is successful at winning a claim against you, they can get to everything inside of that one singular LLC. Now let's compound it to what a lot of people make a mistake about, is adding additional assets. So people will add their business to one LLC, they'll add their investments to the same LLC, and then they'll add rental properties. Now you're really tainting each of those LLCs, because imagine
You have a problem with your rental property and the person wins, they can get your business and they can get your investments. So what do? You firewall them into different partitions. Now I want to put a disclaimer out here. There are a lot of asset protection companies out there, and a lot of them will tell you that if you have multiple rental properties, you need multiple LLCs. This is not accurate. This to me is maybe just a money grab to have you sign up for more things than what you really need. But the bottom line is you only need one singular LLC, and you can set it up as what's called a series LLC, which we'll get into in a minute. But back to the inside attack. So that means that whatever the asset is or was that's inside the LLC is the one that caused the liability. So you segment them into smaller partitions. This is what Delta does. Delta has each of their airplanes in a separate LLC. This way, if one of the planes goes down, while they still are going to pay claims, they are able to limit some of their liability. Now, what is an outside attack? Well, this is what most people think will happen and why they create an LLC. It could be a medical catastrophe, and that could be because Medicare denies a claim. Medicare won't pay for certain advanced cancer treatments. You can't get coverage in most health insurances to go abroad and get maybe better medical service. And if you have a medical expense here in the U.S., then they can come after you for that medical expense. So that is one of the liabilities. Another one is big one is business torts. It could be something where something happens in your business beyond your control and they sue you for it. It could be something that happens on your property. Great example. We've had multiple clients that have had properties where handymen, maids, cleaning services, friends, parties, kids, they get hurt by dogs, by the pool, by tripping and falling, by all kinds of things that we've seen happen to clients. And if you go talk to your insurance agent, of course, what they're going to do is tell you to up the insurance to the maximum amount, which, again, we don't agree with, because it will entice bigger claims the bigger the insurance. So the goal really is to understand how do you limit your liability. So if you have a house in Florida, as an example, and you have a lawn care worker and he gets hurt on your property, you might say, well, I'm protected because he works for a company. Not necessarily. Good case in fact. We had a client in Las Vegas that came to us after the fact and told us about the example of the lawn care worker that got his foot cut off, and his boss let the workers' compensation insurance policy lapse. So they went after the homeowner. They won a couple $1 million claim. In Nevada, at least, you only have a $605,000 asset protection against your house. So they were able to successfully foreclose on the house. Homeowner got $600,000. The injured parties got the rest. So my point is, a lot of things can happen on your property. Happened to me, actually. I had been sued multiple times on rental properties. One was for a fire. Again, they claimed it was arson. The person actually went to jail, but they claimed they were trying to come after me, the insurance company, saying we're not going to pay the claim of the injuries because of you didn't change the batteries. Well, we actually had receipts and we had to go fight with them about it, but you can understand it can run into issues. Again, you have to understand if you have an asset such as rental property, which can be one of the riskiest investments possible, right? What is the difference between a rental property and a stock? A stock, you could lose all your money, right? A rental property, you could lose all your money, but in a stock, you can only lose what you invested. A liability that comes off of a piece of real estate, you can lose way more than your original investment. As a matter of fact, if you don't do it right, you can lose everything that you own. So this is why when you put assets into an LLC, you got to make sure you firewall them. So going back to the outside attack, this would be, let's say you're driving a car and you're in a car accident, you take out that neurosurgeon at the stoplight, or it doesn't even have to kill him, right? You just disable his hands, and you're looking at $5, $10, $15 million in a lawsuit, which most likely your current insurance is not going to cover, or up to that amount. So what happens? Well, now they have a claim against you. Now imagine this scenario. You have your rental properties in an LLC. You live in a state that has homestead protection against your home. Then you have your investments in its own LLC. Let's say now you have all your retirement plan money in a state that protects all of it. There's a rule that personal injury attorneys have, which is don't ever sue a poor person, and don't ever sue somebody that you can't get the assets out of. So that's why lawyers love the insurance policies, because it's easy for them. But if you have your assets set up correctly, this is how you protect it. Because again, if you have an LLC, somebody can still sue you and somebody can still win the lawsuit. Somebody can get a judgment against you. But here's the catch, and the beauty of this is they can't seize your LLC membership interests. Just like with the country club, they can't force their way into the club. The club members or managers of the members of that country club, they're the ones that actually make the decision whether you get into the country club or not. Just like with an LLC. Again, this is really why it's really important to have a strong operating agreement. So if somebody is successful in getting a claim against you, it's what's called a charging order. Now, the charging order basically says they can't have control of the LLC and they can only get distributions when made. They can't force the distributions. That's very different than a corporation. So in a corporation, in many states, they can foreclose on the shares because the shares are your assets. With LLCs, it's the operating agreement that doesn't let somebody into it. So it's a very different structure. Now, the other disadvantage for somebody to try to go after your LLC is if they're successful at claiming a charging order. Basically, it's a lien, right? It's a judgment against your LLC. They get taxed on the value of the charging order, even though the LLC cannot distribute money. So think through this for a second. The lawyer says, I'm going to sue this person for $1 million, but all their assets are protected. If I win the judgment, the only thing I can get is a charging order against the LLC. Now I've got to go to the client and say, hey, I could win you $1 million. You'll pay tax on $1 million, but you'll never get the $1 million. So it takes away the bait or the I would say the motivation of somebody trying to go after the LLC. The problem is when you mix assets inside of one singular LLC, such as putting a risky asset like real estate or business into the same LLC, or putting an investment account of a piece of real estate and a business into the same account. Again, you don't want to combine high risk assets with low risk assets and have it all tainted in case something happens on the inside. So we talk about how this country club works, and there's what's called a single member LLC. And again, this is what's disregarded. So if you go on many of these sites, they'll just ask you, do you want to set up an LLC? Yes. Okay. Put in the names of the people that you want. See, they don't really give you good tax advice or asset protection advice. It's a form you fill out and hopefully you do it right. We find most people do not do it right. So you fill it out, you put your name in there. Now what happens is this is defaulted because you have one person. Defaults to a disregarded entity. You'll hear us talk about disregarded entities in the form of DRE, disregarded entities. So we shorten it up, kind of like NASA, everything's an acronym. So DREs basically mean it's just you. Now, here's an exemption that a lot of people don't know about. If you are married, you can determine whether you want it to be a one-person LLC or a two-person LLC. Now, why is that important? Well, some states do not recognize a one-person LLC as an asset-protected device. Florida is an example, and right now there's about 15 states that don't recognize one-person LLCs. And as of this taping of this video, I don't know what it is at the time you watch it, but if you look at Florida, Florida had a case about 5 years ago, and the judge allowed the piercing of the LLC veil and allowed the person to take everything from this person. Now, I don't know all the facts of the case, but the fact is a one-person LLC was broken, and now in Florida, one-person LLCs are not legitimate asset protection devices. Now, what can you do? Well, if you're married, include both of you, make it a two-person LLC. If you don't want to file it as a partnership, you could also include another member, and it could be a child, it could be a friend, a relative. Give them 1%. You don't give them voting shares. You don't give them any rights. Or what you could do is create another LLC from another state. So typically what we'll do is in Florida, if there's a need to have a Florida LLC, and that's typically if you have an operational business or if you have rental properties, we'll create a Wyoming LLC and make that as a second person into your Florida LLC. Now you can do this with any state, and every state will recognize an outside party, at whether it's an LLC, a corporation, an individual, as the second party. So the choice of whether you file it as single, whether you file it as if you're married, as a single, because again, the IRS will let you choose, even though there's two parties, they'll let you choose. It's as if it's a sole proprietor, single person. So Bob and Mary can be considered just one, or Bob and Mary can be considered two in the IRS's eyes. You have to make that election at the beginning. You can't change it after you elect it. It's a done deal. Now again, the downside of a single or a two-person acting as one is it comes through as a sole proprietor. And we talked about the disadvantages with that again, while you might have lawsuit protection, which a sole proprietor does not, it's a terrible tax outcome because two things: it hits you with the full FICA taxes, and it gets stacked on top of your other income on your Form 1040. It is by far the simplest and easiest to maintain because there's no separate tax return that's needed, but it has the weakest protection because, again, some courts have pierced that LLC veil. So as an example, it might be good for one piece of real estate or a low-risk asset where tax simplicity might just be the issue. So I'll give you an example. Somebody comes to us and they'll say, hey, I have an individual brokerage account sitting over here at Fidelity or Schwab. And if it's in a state that has no asset protection on personal brokerage accounts, and as of the videoing of this, there is no state that provides that. So every state, they can get to your personal assets. Again, part one explains homesteading and retirement exclusions, but personal assets, every state as of this taping, again, things could change, do not have any personal asset protection. Okay, so in something like a brokerage account, you could take that individual account, you could just put it into a one or two person LLC, and all the dividends and all the capital gains, they still flow onto your Form 1040. There's no additional tax return needed. There's no additional taxpayer ID needed. It's very simple, and it will at least give you some asset protection on that brokerage account. Brokerage accounts, bank accounts, anything that's not retirement plan based, meaning IRA, 401k, Roth. Now, when you form an LLC, and it's either husband and wife and you choose to make it two-member, or you can include an outside party and make it a two-member, it's now formed as a partnership. And with a partnership or a 1065 tax return, there is an additional tax return needed. Again, I'm not a fan or a favorite of this because what ends up happening is you either get a K-1 for the profit and or what's called a guaranteed payment. I know it's a weird name, but basically it just means it's excess money that was not paid out in salary. Again, that all still gets hit with FICA taxes. So again, it's stronger protection than just a one person because another person can deny the claiming party getting money. I'll give you a real quick story. I had talked about this in part one, but we had a client in Los Angeles and they had a lot of commercial property. This one commercial investor brought in a partner. He then got a divorce. The partner got a divorce. So there was a claim from the spouse, and then this other partner did not file his taxes correctly, and there was a very large IRS claim. So not only did the ex-wife and the IRS try to attack the LLC to get the piece of property, this client was successfully able to fend off both fights because the operating agreement said she was the only one that could admit new members. And because the property had no distributions coming out, both parties just went away. Because why would you fight and get a charging order on something that you can't collect on? Okay, so caution when mixing partners, because in the example I just gave you, you want to be really careful because while this client was able to protect everything that was in the LLC, let me tell you, for about a year, they were very stressed out, a lot of depositions, a lot of interviews with the IRS. They got run through the gauntlet. So at the end of the day, they won, but it's maybe better you just really carefully choose who you want to be in that LLC. Spouses, obviously the cleanest structure for an LLC. Now, you can go one step further. Instead of claiming a one or two person LLC, which again, one person's always going to be sole proprietor, not great. A two person's always going to be a 1065, unless you take an additional action to upgrade the tax structuring. This is the beauty of an LLC. The IRS lets you choose one of four methods. Method 1, disregarded. Method 2, partnership. Method 3, S Corp. Method 4, C Corp. Let's focus on the S Corp for just a minute. In order to get an S Corp, you first have to file the LLC, you got to get it state approved, and then you have to file additional forms with the IRS and make sure you are doing everything by certified mail, by fax, because they are just famous for losing these forms and then claiming you never filed them. So this is a problem because you cannot file a Form 2553 electronically. You have to do it by mail. I know, what are we, in the 1970s? But it is the way it is, and you got to be very careful. We've had multiple times where we have filed for S Corps for clients, and we have now basically had to take a picture of the form as it's going into the envelope. Then we take a picture of the certified mail, because we've even had IRS agents where they've said, yeah, we never got it. Well, you signed for the certified mail, and they said, well, how do we know? How do you prove that you put that into the mail? So somebody opened it, they took the form out, they never processed it, they lost it, and then they wanted to try to claim a penalty to the taxpayer when in fact somebody just lost it. So you got to be very careful when you deal with the IRS that you're documenting and picturing every single stage, because they will pull this. Okay, so make a long story short, pay yourself a reasonable salary. Now we do have a program that we run through to protect people against audits called Reasonable Salary. It's an AI program that we developed, and it's all based upon what the IRS audits have been, where they try to go after people for reasonable salary. Now, many people are like, well, what is reasonable salary? Well, a lot of times we'll get doctors that will come in, or dentists, or architects, or business owners, and some accountant or advisor or CPA has said, hey, go set up an S Corp. And so an example is, we just had a doctor come in making $200,000 a year under an S Corp, pays himself $200,000 a year in salary. We said, well, who told you to do this? Well, my CPA. Well, wait a minute. Why would your CPA tell you to take the whole amount out? He says, oh, because you have to pay out whatever your profit is. So it's bad advice. So we ran this through the reasonable comp analysis software, and it came out he should only be paying himself $75,000 a year. Now, this is different for every single person. It's based upon the number of hours that you work, the discipline, what's your replacement value, the zip code you live in. There's a lot of factors that the IRS uses, but the goal is, if you're able to pay, say, $200,000 and only $75,000 in salary, that means you're paying that 15.3% in FICA taxes on the $75,000, but the other $125,000 is now excluded from any kind of FICA taxes. That is exactly why the IRS wants to fight it. They're usually successful when people haven't done it right, because people just don't know how to peg their reasonable salary. If you're paying too much in reasonable salary, the IRS isn't going to bother you. But if you pay too little, they're going to bother you and try to penalize you. The goal is get that number right where it should be. So again, if you had $200,000 of profit, you pay yourself $75,000 in salary, the extra $125,000 comes through to you as a K-1 distribution without the FICA taxes. Now, again, there's a lot of different methods as how you can do this in setting up an S Corp. Now, the next one, the fourth one, is a C Corp. This is going to be one of the best strategies if you pair the two together. Now, I'll explain that if you're going to do just an investment management account, you're trying to just protect brokerage, just do the disregarded entity. There is no need to get any kind of complication, because there's no tax benefits using an S Corp or a C Corp anymore. There used to be. And it's just a disregarded entity. If you have an operational business, property management company, architect, doctor, whatever it is, you sell widgets on the corner, an S Corp might be the next step. But now if you have excess income, we know that we live in a progressive tax society. The more you earn, the more the rate you pay on that additional earnings. So if you think through the concept, you sit there and you pour income on top of each other, interest, dividends, W-2, all these different things. Your income goes up, and so does your tax rate. The idea of the C Corp is you break it out into two separate tax returns. So a C Corp has its own tax return, and it's taxed at 21%. So if you think about it, you know, we have had people come in and they're doctors making $1 million a year, and they're all flowing that money. They're flowing all that money right into their 1040, and they're paying 40% in tax. And then if you live in a state like New York or California, you're probably paying 15 to 16% in tax. On top of the federal, you're paying 55 to 65%. So the goal is you siphon that off into the C Corp, and what you do with the C Corp is it pays its own 21% of tax. Again, additional forms that need to be filed to get this qualified with the IRS. You see the Form 8832 and the Form 2553. These are things that you have to file correctly with the IRS to get the permission to classify the LLC as a C Corp taxation. Again, it's still an LLC. It's not a corporation, but it's taxed as if it was a corporation. All the same rules, everything. So the beauty is you can bifurcate or separate out some income into a 21%. So if you're 40%, everything you can legitimately get into a C Corp is going to be almost at half the tax rate. Now, what a lot of people will come back to me and say is, well, you can't keep more than $250,000 in retained earnings because there's a penalty. This comes out of the accounting and CPA from people that just don't understand it. If you look at Apple and they've got $900 billion sitting in retained earnings, okay, they're not paying any penalties. Why? The IRS allows exemptions on this that says if you can show that it has business purpose, that you're expanding and that you're reinvesting, there is no limit on the retained earnings. Second big objection you'll get if you do your own reading or you talk to some CPAs, high-end CPAs understand this, but some CPAs or some accountants, they just don't get it. They'll tell you there's double taxation. And if you pay out money from a C corporation, you're going to pay the corporate tax plus the individual tax. By the way, we've never had a client do that because it's ridiculous. Why would you have double taxation? So again, if you hear, oh, don't ever use a C corp because it's doubly taxed, whoever is telling you that does not understand how to structure and use a C corp so that you avoid the double taxation. All right, let's go back to Billy Bob, who went out and bought those 5 properties. And what we're going to do is we're going to show you how he's going to create what's called a series LLC. Now, can you do this with investments? Yes, but there's not a purpose. Meaning, if I have 3 brokerage accounts at $1 million a piece, I don't need to keep them in separate series. There's no inside risk. I mean, I'm not driving a vehicle inside the LLC. I'm not running a business inside the LLC. I'm not running a rental property inside the LLC. There's nothing interior of that LLC that can cause risk. But if I'm running a business, should I use a separate LLC, a series LLC? Maybe I have 3 businesses. Definitely not. That just poses accounting and IRS disclosure rules, because if you put each business in its own LLC, they're supposed to funnel up to the top, the master LLC. And if you have operating businesses, that means that one LLC can cause issues in accounting, etc. Now, with a rental property, it's a little bit different. With a rental property, you can create multiple sub-LLCs within one master LLC. So think about like a pyramid. At the top of the pyramid, you have your master LLC, and then every rental property gets its own series LLC. This is the way that you prevent the crossover. So if you have one liability on one piece of property, it's not going to bleed over into the other property. Now, if you have series LLCs, people will come to me and they'll say, well, I only got 3 rental properties. What do you think? It really depends upon your situation. If you have those rental properties mortgaged up and there's very little equity, if there's less than 30 to 40% equity, typically you can use one LLC, because a lawyer is going to look at that and go, even if I win on the inside attack, there's so much debt on it, and even after I fire sale it, there'll be nothing left. Now, if you're holding, say, 3 $1 million properties with no mortgages at all that debt is free, all the equity is available for a plaintiff, yes, there's when you can consider setting up different series LLCs, or different series for each of the properties. The upside of the series LLC is it just prevents you from having all this complication of having a separate LLC for every single thing. Again, if you have an investment management LLC, simpler, just holds brokerage accounts, stocks, bonds, bank accounts, etc. It separates the investments from your personal liability exposure. And then again, a business LLC, it's there to run the day-to-day business. However, when you're running a business, depending upon how much you're making, now if you're making $30,000 to $50,000, you're not going to use what's called a multi-tiered LLC. You're going to just use one LLC. But if you start earning $100,000, $150,000, $500,000, $1 million, now is the time where you maybe create a multi-tiered LLC system. So you have what's called a holding company, LLC, holdco, and what that does is that creates a management agreement with a sub-LLC. And now you're able to maybe classify one as a C Corp and classify one as an S Corp and get the best benefits of everything, following all IRS guidelines. At no time during this discussion do I want you to take a gray area. Follow the rules, black and white. There is no gray. It's all binary. It's either you can do it or you can't do it. Don't go in between. You'll hear a lot of people say, well, my lawyer told me I could do this. My accountant told me I could do this. It's legal. Listen, if it is, prove it. Because we've seen so many times people have come to us and said, oh, well, my accountant told me I could do this. And no, you can't. It's against IRS code. Or my lawyer set this up and told me I could operate it this way. Sometimes, no, you can't. You got to follow what the IRS outlines to stay out of trouble. Now, again, a lot of times people think that they have to form these LLCs in the state that they live in. That is absolutely incorrect. If you are forming an investment management LLC, it doesn't matter what state you're in. It matters what is the best state to form it in. So you could be a Florida resident, you could have a Wyoming, South Dakota, Nevada LLC. It's really what state is going to be the best. Why did most companies go to Delaware, even though they weren't in Delaware, to form their companies? Most of the high-tech companies used to form in Delaware. And then as you saw, the dispute that Elon Musk had with Delaware and their corporate courts, a lot of people now are not using Delaware. They're moving their corporations and their LLCs to Wyoming, South Dakota, Nevada. Again, Delaware still has some real benefits, but the point is you don't have to form your LLC in the state that you actually live in. What's the worst state? In my opinion, California. You could form an LLC in California. You got to pay them $800 a year, whether you make money or not. So it's the greater of the state income corporate tax or $800. So you could literally lose money in your business and you still owe the state for the privilege of actually having it there. Versus, say, a Wyoming, you have $150 a year, and that's it. So again, in Wyoming, you don't have state income tax. But in California, you're paying the minimum of the state income tax, or $800, versus Wyoming, no state income tax, you pay $150. So the top states to form these kinds of LLCs in are Wyoming, Nevada, New Mexico, Delaware. Maybe Delaware's going to fall off. I don't know. It's on the brink right now. There are certain states that offer what's called blind LLCs. Wyoming is the favorite one for most people because it allows you to create an LLC and stay 100% anonymous. Why is that important? Well, let's say that you're in a car accident. First thing that the personal injury lawyer is going to do, they're going to hire a private investigator. They're going to try to do a name and asset search. They're going to try to figure out whether you're worth suing or not. Now, having a blind LLC does not prevent you from getting sued. And as a matter of fact, if you are sued, you do have to disclose that asset, because what they'll do is they're going to send you a discovery form, and you have to fill out your income and your assets and everything. And then the suing lawyer will determine whether you're a worthwhile target or not. So again, this just prevents that upfront search and the lack of privacy that many states have. So you also have to find a registered agent. Now, I've seen this over and over again. People will go online, they'll form their own LLC, and then the company that's forming it will say, do you want to be your own registered agent, or do you want us to be your registered agent? And people look and say, well, it's $150, it's $180 a year. Why not be my own registered agent? Here is why. You should never, ever be your own registered agent, because there's what's called a default judgment, meaning if, let's say that you live, great example is you live in Nevada. Okay, Nevada has a rule that process servers cannot pass by a guard gate, a gated community. So let's say that you're sued for whatever it is. Process server is trying to get a hold of you to give you the lawsuit, and they can't get into your community. So what do? Well, they mail it, but it's not legally acceptable. They have to physically hand it to you. So now what they could do is if they say they can't get a hold of you, they can go to default judgment, meaning can't find you, can't get a hold of you. And many states have anywhere between 20 to 60 days where if you don't answer a complaint, then the other party automatically wins the lawsuit. So let's imagine you're on a cruise for a month and they're trying to serve you and they can't find you. You could literally make them win by just not giving you service. Why is a registered agent with a professional company worth it to me? Because look, if there's a business that's open 9 to 5, Monday through Friday, they're always open to be served. This way, even if you're sitting on some cruise ship, at least now you have time to answer the complaint. So again, I would not try to save a couple bucks by being your own registered agent. We had somebody in Vegas that said, yeah, that's just, it's a money grab. I'm not paying that. Sure enough, it happened to them. Now, they did get out of it because they were able to argue, but it cost them an extra $15,000 in legal fees, going back and forth with the judge, explaining the circumstances. The judge bought into it, but it doesn't mean that every judge is going to do that. So again, privacy, first line of defense, and particularly valuable for real estate holdings. Now, here's another issue. A lot of people that own real estate, they let the tenants know that they're the owners. Another big mistake. Because once they know that you're the owner and something happens, they're going to come after you personally. It's always better if you own real estate to hold it inside of an LLC, and then you have a separate LLC that's a property management company. And you can simply say, I'm the property manager, and the owner is a corporate owner. And this way, it also keeps you off their radar, because sometimes tenants will just get mad and they'll just want to come after you as revenge. And unfortunately, in this country, anybody can file a lawsuit. No, it costs almost nothing, but it costs you a lot to defend it. So getting back to the operating agreement, this is the DNA of your whole structure. It defines how you are operated, who controls it, how assets are distributed. And most of what I've seen is they're weak, they're generic online templates, and it defeats the whole purpose and the structure of creating the LLC to begin with. So again, without the proper provisions, courts can easily pierce the veil, treating the LLC as if it doesn't exist. Also, commingling, acting like the LLC is your own account, is also a very big danger. There are some easy guidelines, especially if it's a one-person LLC, some easy guidelines, but you also have to make sure that they're separate in not only legal structure, but also in how you operate them. So your operating agreement, it must define what are the charging order protections and restrictions on transfer, what is the management structure and distribution rules, dissolution provisions, how do you get rid of it, buy-sell clauses if you get sick, and succession planning. Now again, another big mistake we see, people form their LLCs online or some law office, whoever does it, and we find that their shares, I know they're not called shares, they're called membership interest, they're listed in the person's name. Now think through this for a second. You go to somebody and they say, create a family trust, put everything into the family trust, and then we find the LLCs are always left out. What you have to do is after you form the LLC, after you issue the membership interest, you have to then reassign the membership interest to people's trusts so that the membership interests do not go through probate. The other thing I tell people is don't ever form an LLC with your own name. Create some unique name that can never be linked back to you just for privacy reasons, especially if you're going to do a blind LLC. You don't want to put Billy Bob and then have a blind LLC. Somebody's going to find out that it's yours. So what do? File your articles of organization with the Secretary of State of your choice that you're choosing the state. You have to designate the registered agent in that state. You can't, let's say you form a Wyoming LLC, you can't be a Florida resident and be the registered agent for a Wyoming LLC. You have to have somebody in Wyoming because the courts will serve the person in the state where you have that LLC. Now, if you do operate in another state, now this does not have anything to do with investment management LLCs, primarily operational LLCs or rental properties LLCs. You have to do what's called a foreign qualification. All right, that way that the state knows that you're operating a business or a rental property business in your state. Now, depending upon if you're going to go past just a disregarded entity and you're going to file as a partnership, S Corp, or C Corp, you also have to get a taxpayer ID number. Now, you can do this if you're confident. They're a little complicated because there's a lot of check boxes that refer back to IRS tax code. But if you're going to file it as an S Corp, you're going to file an 2553 or an 8832 for a C Corp. And again, if you're going to stick with a two-member party, non-spouses, or you're classifying two spouses as separate parties, you're going to file a Form 1065. Now again, if you're going to file some of these forms, you got to be on time. There's big penalties for missing or being late, just like with your tax returns. Okay, so here's the roadmap. Number one, plan what kind of LLC. Is it going to be real estate, investment, or operational? Choose the right state, depending upon what your operation is. Again, if it's investment management, free reign. If it's real estate or operational businesses, you have to consider maybe filing the foreign entity in your state for the operation of that business. Draft the proper operating agreement. Select a a unique name and file your articles of organization with the state. And then if you're going to use partnership, C Corp, S Corp, then you have to complete additional IRS filings. And when we get to part 3, we're going to really go through how to manage these. Because I've seen a lot of people, they'll say, I just don't want all this extra complication in my life. Look, if all you're trying to do is protect an investment account, you're going to file an LLC in another state, and that's it. You're going to pay their annual fee, which we tell people, look, just consider it like an insurance policy, right? It's one more level of protection. So that's all you're going to do if you're going to do it as a investment management LLC. Real estate gets a little bit more complicated. You might need some help with that. And also, if you're definitely going to need some help if you're running an operational business and you're going to set up multi-tiered LLCs. All right, so moving on to part 3, I'm going to go through how to manage and keep your LLC clean